Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, it feels pretty quiet right now, but that's not going to last.
I know. Friday threw us all for a loop with the gold story.
Yeah, you and I lived that together. It was fun. Let's get to the biggest stories right now in the more than $17 trillion global ETF industry. A summer lull. Investors in wait-and-see mode on this Monday as they await inflation data coming tomorrow.
So, of course, we will discuss the anticipation in these markets and how clients are demanding more access to private assets with Cinthia Murphy from TMX VettaFi.
And we will also look outside the U.S. when we talk with Fidelity's Greg Friedman, drilling down into his international ETF. All of that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. So, look, VU at the top, IVV number 2, more of the same. The term we use is comfortably bullish. One thing giving these bulls comfort, though, is they're also buying things like gold, and on here you can see short-term treasuries, right? So a lot of people are buying some risk off as they buy risk on. It's sort of like buying everything. That's why the ETF flows are almost 700 billion on the year, because you have both sides getting bought. XLC is also interesting. We haven't seen a lot of sector ETFs up here recently, but somebody has rotated into communications. And then look at small caps. Somebody's trying to make small caps happen again. We'll see if, the 80th time it'll work. Let's look at the outflows here. We're going to see SPY and the Qs at the top, so a little trader money taking some profits here. This is the whole story of the year. It's never quite totally bullish, but it's leans net bullish. Soxel, some money coming out of semis, and here's financials. So somebody might have rotated from financials into communications. Let's look at we have these indexes we make in BI for ETF flows, and we have one called risk on and risk off. So risk on is like growth, tech, junk bonds, and risk off would be gold and cash and that kind of stuff. So you can see that this year, people are buying risk on and risk off a lot together. See how they're both up? That's kind of unique. Normally, it's one or the other. People move from one to the other. So I think a lot of this year can be defined by staying with the market, right? Staying invested, but buying a little, cash and gold to sort of make yourself feel better and give you that comfort, Katie. And I think that's the trade of this year.
Eric, thank you. Let's keep the conversation going now with Cinthia Murphy. She is investment strategist over at TMX VettaFi. And let's pick up right there, Cinthia. I think that's really interesting that investors are buying both their hedges and their risk-on assets kind of at an even clip right now. What do you think that says about the current market environment that we're in?
Hi, Katie. I think it's the perfect translation to the year of uncertainty. So, I don't know about you, but I'd never heard the word diversification thrown around more often than we have this year. And it's just that, markets keep defying all the negative narrative. We've tried to make it stick this year, all about tariffs and about economic growth slowing down and recession. And the markets keep going up, forging new highs. All-time highs are like such a common story. We barely blink at it anymore. And yet, we know folks are nervous about what if something actually happens. So I think it makes sense given that uncertainty has been our buzzword this year.
That's a really good point, but I'm curious what diversification looks like in August of 2025 versus, say, in April of 2025.
Last week we did an alternative symposium where we had a bunch of advisors come together and we talk about the alternatives asset class. And what I found surprising about that, to the question about how are advisors diversifying, is that primarily they're still going to traditional things like bonds and cash. When we asked, one of the polls we asked last week is like, okay, what's your preferred type of asset when you're looking for the diversification and the downside protection? And the list included everything you can imagine, like liquid alts and in crypto and bonds, cash, hedge funds. And more than half of the advisors are saying bonds and cash are my go-to. So it continues to be a space where I think there's a lot of friction really to get into the alternative space. There's a lot of due diligence, a lot of products that are not like the other, a lot of unique approaches. So we continue to see advisors going to that ultra short bond space, which is yielding a lot, more than 4.5%. And the cash-like exposure, we continue to talk about the amount of money sitting in money market funds today. Now we have money market ETFs. So that parking that cash on the sidelines, that sticking to the short end of the curve continue to be themes we're seeing when it comes to the diversification.
And Cinthia, last week we saw that executive order that's going to potentially allow private assets into 401k plans. and crypto, really just opening a lot of Pandora's box there for retail to get outside of the 60-40. What do you make of this? Do you think this will see a lot of inflows, or will those target date funds that people like so much kind of stick really to stocks and bonds mostly, or do you think they're going to evolve?
You know, talk about Pandora's box. I love the philosophical conversation about, opening 401k to everything out there, including private markets. I love an access story. It's here, you can have it all. If you think about it, is this the best place for things like these type of assets versus other ways to access like interval funds and stuff? Probably not. If you think about the purpose of a retirement fund, a defined contribution plan is capital growth, but it's primarily capital preservation for, retirement income generation. So you don't want to necessarily go crazy with risk in those portfolios, especially as you approach retirement. That said, for a lot of folks, 401k is all they have. A lot of investors out there, that is their entire nest egg in terms of investing and accessing markets. So they're missing out on a big portion of the market. So I see the argument for, hey, let's open up the space. I see the argument for asset managers in the alt space that are looking to broaden their asset base. So also great for them. But I cannot even begin to imagine what the implementation of that looks like, because, defined contribution plan sponsors, they're fiduciaries. So it's on them to go do the due diligence, to put the menu of options together for the investors, to figure out what makes sense. So it's a huge hurdle from idea to implementation.
It's a great point that it's not like switching a light switch necessarily. Cinthia, I do want to just meditate on the fact that, okay, we have this executive order. We could see private assets. We could see crypto in 401ks, but we still don't have ETFs in 401ks. It's interesting that this came first.
I think it's probably just a momentum story, if that even applies here. It's all about this regulatory push of, hey, we're friendly. We're going to be bringing down the gates, opening down barriers when it comes to regulatory framework for all sorts of things. And that crypto conversation is the hottest conversation this year. So I think it's kind of makes sense. And in truth, we haven't figured out the plumbing for how to put ETFs in 401ks, which also tells the story of how we're even going to do this, private assets in 401ks. So I think it's more of a conceptual, hey, this is what the crowd wants. Let's give it to them. Here's this legislation. This is an executive order. We're going to be really friendly to crypto. How do we actually make that happen now? I'm going to be looking, because I have no idea how they're going to make this happen.
Yeah, well, now comes the hard part, right? So, Cinthia, if you take a step back here, what are you worried about? What's the next shoe potentially to drop here?
I am really curious. I mean, we're all looking at the rates. I continue to see the market looking for that 2 rate cut, and that's going to really kind of drive what the market's in the second half. I'm being kind of surprised with the resilience of the market in a year like 2025. The strength has been really interesting despite all odds. I don't really see the data really supporting 2 rate cuts this year. It seems like, it keeps defying the Fed, who's been really reluctant to go that route. So I think we're going to keep watching for that, because that could be the catalyst for what comes next. Beyond that, I think in the ETF space specifically, I don't know what else we can come up with. I mean, the amount of product launches that have come to market has been dizzying and nearly impossible to keep up with, but a lot of things too that I don't even understand how anybody would begin to use it in a portfolio. So there's a lot of noise in our industry, a lot of product coming to market that it's been interesting to see our folks actually going to be using some of this stuff. So it's a different ETF world than it was 10, 20 years ago. So it's been kind of a dizzying market all around.
Yeah. And every day is a new day. Cinthia, great to get some time with you. That is Cinthia Murphy of TMX VettaFi. Now coming up, gold in the headlines, and Bloomberg Intelligence says it's still a better hedge than Bitcoin. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with LQD. This tracks investment grade debt. It took in $1 billion on a single day last week. But as you can see, over the course of 2025, it's been a lot of two-way flow. We seem to be building in some sessions of inflows right now, but this fund has still lost $1.5 billion so far this year. So we'll keep a close eye on LQD. But let's talk a little bit about State Street. This is a really interesting story. State Street will replace Alps as the distributor of the Select Sector Spider funds. That is a lineup that counts 11 funds and over $300 billion of assets in its roster. Now, these fees, once paid to Alps, will now stay with State Street. So a little bit of a windfall there. And Scarlett, I want to end with gold. It's declining today after the White House suggested that bullion bars shouldn't face tariffs, but they said that they would give us some clarity on those headlines from Friday suggesting that actually they would tariff imports of gold. So there's just a lot of question marks, and you can see that expressed in GLD over the past 5 days.
Yeah, it's been all over the place, gold prices and GLD as well. So let's talk more about gold, especially its role here vis-a-vis other assets like maybe Bitcoin, with Athanasios Psarofagis of Bloomberg Intelligence. And Athanasios, you recently wrote a research report saying Bitcoin is not likely to save you when the market does go down. Talk a little bit about gold and its role here, especially in light of the confusing headlines that we've been getting from the White House.
Yeah, sure. And I know Bitcoin comes up like, is it an inflation hedge? Is it a market hedge? I don't know. But we wanted to test it against the market, right? So what happens when the market goes down? How does Bitcoin behave? How does gold behave? So we found, I used just when the ETF launched, on the down days, gold tends to do better. Maybe, the S&P is up today, but maybe today's not the perfect example. But over time, gold did end up holding up better on market down days. Bitcoin didn't. But the flip of that is when the market was up, Bitcoin gave you a lot more pop than what gold would do.
Yeah, I think Bitcoin, and I get it gets put in as like a hedge for everything, but it's really a hedge for the global money printer, right? If you look at the liquidity chart, it really tracks well with that. But it is not, and gold isn't that great of a hedge either, though. I mean, they're both very shaky. Bitcoin is worse, though.
It is better, but I think this is the problem with Bitcoin. Like, what is it? Is it a currency? Is it an inflation hedge? Is it beta? Is it a store of value? We got to pick a lane.
Eric, what did you say Bitcoin is?
I said it's a hedge against the global money printer.
Or a belief system, too, right?
Yeah, it's also a little bit of a religion. And, some people call it a psychological asset. It's people give it value, so it has value, and it is limited at 21 million. So, and the government can't mess with it. I think people like that.
That's probably fair.
No, it's a fair point. It just, we wanted to look at when the market goes down, and let's say when the chips are down, it doesn't seem like Bitcoin was there, right, on these really big down market days.
I do want to go back to what happened on Friday, because we got this back and forth on tariff headlines. I did the open, and okay, tariffs on gold imports were coming, and then Scarlett and I anchored the close together, and actually we were waiting clarification. In that intervening period, I spoke with Michael Saylor of Strategy, and he made the point that you can't tariff cyberspace, I think were his terms. So, I mean, you think about crypto, and in this new brand new world where actually you could tariff gold imports, I guess either one of you can answer this. I memean, crypto has to appeal to its fan base of, this is kind of outside the government.
Yeah, no doubt. That's part of its appeal. But you could tax it. It's not like it's not totally outside of this system. It's just the government can't dilute it by making more Bitcoin, and that's what people like, because governments love to dilute currencies.
So I'm curious, how many people wrote back to you after you published that research?
I thought I'd get more hate mail, but no, it wasn't bad. But it did well. It was well read, and I think people just appreciate the different angle, right? Like just seeing how Bitcoin, as it's becoming more adopted, it's going to start to behave differently, right? So I just think people wanted to see how it actually behaves in the market.
All right, Athanasios Psarofagis of Bloomberg Intelligence, always with the great research headlines. Really appreciate your joining us today. Still ahead on ETF IQ, a reminder that you can listen to Eric and Joel Weber on Trillions. It is their podcast that covers the industry, but we are going to talk about investing in international stocks next. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence with us now for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at an international active ETF from Fidelity, FENI, the Enhanced International ETF. Classic active strategy here. I thought we should do international because we haven't covered it in a while and it's having a really good year. If we look here, active, yes, that's how you know. 29 bips, that is cheap for active, especially for Fidelity. I mean, a lot of these funds typically charge a lot more in the mutual fund wrapper. You can see the inception, it's an older fund. I believe it converted from a mutual fund. And then here's the market cap, 3.6 billion. We have a phrase in the team, they grow up so fast. That's a lot of money. You open some of these and they're bigger than you think. Let's look at the cross-section of what it invested in. So international, here are the countries. This is the key. Japan, UK, Germany, France, Switzerland. So this will differ a little from, say, the EFA, which is generally the developed market international benchmark. And you can see the exposures you get here. You definitely get a lot of banks when you go international. They rule international exposures, but you get a lot of other industries. Look at the PE here, 16. Again, that's really low compared to the U.S. That's what people like international and has room to run. Let's look at the performance of this versus the EFA and versus the S&P this year. So you can see it's up 24, a little better than its benchmark, so that's good. And they're both crushing the U.S. market. That said, since April 7th, the U.S. has come back big time. And if you zoom out, the U.S. would dominate both of those. But still, Katie, this is a good sign for international having this nice run this year.
All right, Eric, thank you. And joining us to talk about this ETF, I'm pleased to say, is Greg Friedman. He is head of ETF management and strategy over at Fidelity. Greg, great to see you in person.
Thanks for having me.
So we'll talk about the strategy of this fund, but as Eric mentioned, you converted this from a mutual fund at the end of 2023. So it's been just about 2 years here. Talk us through that experience. What have the past 2 years looked like for this fund?
I mean, the fund's had, fantastic returns. It's beat its benchmark, in every category, 1 year, 2 year, 3 year, 5 year. It's a 5-star rated by Morningstar. So the performance has been strong. We did convert it in 2023. The fund was originally established in 2007. So it's got a great heritage and history of outperforming its benchmark.
I want to go back to what Eric highlighted, which is since April 8th, the U.S. has really more than caught up with the rest of the world after lagging for most of the year. To what extent are investors, especially those outside the U.S., underweight the U.S. market versus the rest of the world?
Well, we look at it as a building block. So this enhanced fund, which is a quantitative active strategy, is a one of 8 products that's in a suite. So our clients are looking at is how do I put a portfolio together? These are low tracking error, about 1% to 2%. The overweight, underweight against the benchmark are about 1%. So it allows them to get the outperformance while protecting the downside. So when you're looking at the question of what do non-U.S. investors are looking at versus the U.S. market, this is one piece of a larger puzzle on a portfolio construction methodology.
It has been difficult, I think, to sell international in general, even with this year. This one actually, by the way, half of the assets came in since the conversion, so that's good for you. But how do you sell international to an investor who's like, why would I not want to own Apple, Google, Amazon, those Mag 7 names? They kick butt. They're going to go do a lot of growth. I don't know about Nestle and some of these companies in Europe. That's how we feel on the team sometimes that the U.S. investor thinks. How do you sell them out of that?
Well, there's it's the term of diversification. We're in the U.S. probably too heavy with U.S. equity or U.S. exposure. So this fund allows them the diversification away from U.S. markets. In addition, you're absolutely right. The overseas markets, the European markets have been under clubbing the U.S. market for a while. But this year alone, non-U.S. is up 22%, U.S. is up 9%. So that outperformance, in addition to the concept that we keep educating our investors on, diversification allows for this story to resonate.
So I get taking the U.S. out of the picture. Ex-U.S. is a phrase we've been hearing a lot this year, for example. Why Canada? This one excludes the U.S. and Canada. Well,
the Canadian market is correlated very closely to the U.S., not exactly, but it's close enough that we think that, part of our quantitative approach is to be stock-specific, risk-controlled. So we want to make sure we are true to the benchmark of international or non-U.S. names.
And of course, as Eric pointed out earlier, a lot of exposure to the financials. Banks and insurers make up about 20% of the fund. Not so much to tech. Semiconductors and internet together combined for 6.7%. If you wanted to increase your weighting in technology, how would that skew the geographical representation?
Well, we're staying true to the benchmark. Well, once again, this is a low tracking error, so we're not taking the 3 to 4% active tracking error. We're 1 to 2%. So we're staying close to the benchmark. We're emphasizing the stocks we think are going to outperform while protects from the downside on the risk. So with a tracking error of 1 or 2%, our overweight, underweight versus the benchmark are a percent at most.
Okay.
Trivia. What is Fidelity's biggest ETF?
Tell us.
Okay, it's the Bitcoin ETF. Believe it or not, that is their biggest ETF at 23
By
billion.
assets.
By assets. But the Ether ETF has taken in more money this year. This is interesting. You guys are a very history shop. You're getting into this new space. What's that been like, and who is buying these ETFs?
Well, it's across the board. So it's individuals, our retail platform and our brand resonates. Obviously, the institutional, the advisory, and the intermediary are big customers as well. We're thrilled with the results so far on the crypto funds, but we listen to our clients. We know this is an area of high demand, and we want to make sure we deliver quality products for what they need for their investment solution. So we're thrilled with the results so far across the board of our ETF family.
Well, to that point that, this is client demand driven, what are clients demanding right now? What are they asking for at this moment in 2025?
Yeah, they're looking for active. The active story has been tremendous. Our heritage, 75 years of bottoms-up fundamental investing resonates well. If you look at the 1.2 trillion in active ETFs to date, 10% of all flows have been in active ETFs versus 2 or 3% last year. So our focus is how do we deliver the best of Fidelity, which with our heritage is the active equity space.
All right, Greg, great to get some time with you. That is Greg Friedman of Fidelity. And you can read about this drill down, plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. Really interesting conversation. I'm glad you brought up that point about Ether versus Bitcoin, because that's been the story that's emerged just recently, is that Ether seems to be really attracting eyeballs.
Yeah, building the tech rails for the blockchain, I think Ether got a couple wins narrative-wise, and it's up 100%, by the way, in 3 months. That'll definitely get some takers.
Also, being the backbone of stablecoin makes up for a lot
That's
of.
true.
Those are like real things people can latch onto, because Ether was like, what even is it? It didn't have a catchy little soundbite you could sell it with, but now I think people get it. Stablecoins.
Yeah, we've been socialized to what exactly Ether is. That does it for Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.